PhillipCapital Weekly Market Watch. I'm Lin Sin from Phillip Securities Research. Today, we will be looking into the growth prospects in the Asia ex-Japan markets and some of the potential challenges ahead of them. Asia ex-Japan markets were jittery about woes on premature tightening of interest rate in US, as well as the geopolitical crisis spanning from west to east, including the elevated tension from the seemingly relentless advances made by ISIS and the prolonged pro-democracy unrest in Hong Kong. While the correction in Chinese property market remains a drag to the region's economy, heightened volatility in the capital market, as well as economic activities. Reforms and restructuring posted potential headwinds and challenge in the region, where we will continue to see growth moderating. Having said that, the markets have recently seen some recovery from a sell-off triggered by the International Monetary Fund's downward revision of global growth for 2014 from 3.6% to 3.3%, and for 2015, 3.9% to 3.8%. Markets are also shrugging off what seems to be a more hawkish tone from the Fed as the US economy improves and rate normalization becomes more dependent on a broader base of economic indicators than just employment alone. We expect a resilient global economy anchored by a strengthening US, which will help to offset weakness in the Eurozone, Japan, and China. Despite that a premature tightening of US interest rates will send a jolt to the market, it also signals a stable US recovery, which should bode well for the region's exports. The region is expected to grow at a moderate pace, underpinned by upbeat exports and manufacturing outputs as the US economy gains traction. Trade and industrial production will somewhat offset the slackening domestic demand. Notwithstanding the divergence of monetary policy in between the US Fed and other central banks, which contributed to a stronger USD, affecting Asia and broader emerging markets, central banks in the region are likely to maintain supportive monetary policy amidst mounting global disinflationary pressures, which stemming from the lower oil and commodity prices. On the flip side, the recent declines in oil prices will also be a boon to the global economy and could be a powerful growth stimulus if sustained. Meanwhile, Japan actually surprised the market on last Friday by increasing its target for monetary expansion to anchor inflation expectations given the current downward pressures on prices. The quantitative easing program targets a Japanese yen of 800 trillion expansion in the monetary base by buying more Japanese government bonds. The central bank also said it will triple its annual purchases of exchange-traded funds and Japanese real estate investment trusts. Reforms and restructuring have taken a toll on the region's economy in the short run, but will be beneficial in the long run. Better fundamentals will help economy to weather through economic crisis in future. Enhanced policies will create a pro-business environment, increase competitiveness and efficiency of economic activities, as well as corporate profitability. Therefore, in turn, improve its people's standard of living. Greater openness to foreign direct investment, FDI, is a crucial driver to spur growth and drive efficiency, while policymakers are curbing fiscal deficit. Gradual liberalization in the region is seen over the last 2 decades, cutting back restrictions and revolve from the controversial political ideology nationalism to attract FDI. As mentioned earlier, with all the headwinds, this is just a recap, and as headwinds persist, a strong and sustainable pickup is still some way away. On the balance, we remain broadly positive on AXJ market. However, equity market performances are highly dependent on domestic reform and restructure agendas that are still gripping the region. If governments get it right, we will see greater resilience, sustainability, and a rise in potential growth trajectories. Otherwise, we will see continued subpar growth, vulnerable to short-term capital flows, and inflation spikes. Breaking down the region, we maintain overweight on China and India as reforms are already underway for these economies. For China, reform may seem to raise risk to growth in the short term, but we see that necessary adjustments are already underway in trimming overcapacities, tackling corruption, and broadening the fiscal base for local governments' budgets. For India, we are positive on the broad political support that Prime Minister Modi seems to be enjoying to push through his agenda of removing bottlenecks to investment and fiscal responsibilities. We maintain overweight on Indonesia as well, on hope for structural reform, but we admit that there is political risk to this call. Unlike Prime Minister Modi, President Jokowi may face much stiffer political resistance to his reform agenda. Indonesia remains vulnerable with subpar growth and twin deficits. We are neutral weight on Singapore as restructuring bites. As for Thailand, we are also neutral weight on the back of political uncertainties. As for Malaysia, neutral weight as well, due to inflationary pressures mounting. To capture the long-term growth opportunities in the region, you may wish to consider to invest into the following unit trusts or ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Securities Research. Tune in for more Market Watch videos.